I got a question for you. What if I told you that 20 to 30% of your clients are costing you money? Not just low profit, like actually costing you money. That these clients of yours are consuming more resources than they're paying for. They're creating stress, rework, and chaos. And they're preventing you from serving the clients who actually value your work. Because here's what David Maister discovered. He discovered that most CPA firms are not unprofitable because they don't work hard enough. They are unprofitable because they are serving the wrong types of clients at the wrong prices. Today, we're talking about pricing, profitability, and saying no to bad clients. And I'm going to show you why the clients you think are keeping you afloat might actually be sinking you. So who am I? My name is Ephraim Asher, and I help CPA firm owners running 1 to 5 million remove themselves as bottlenecks from their firm so they can take on more clients and their firm can smoothly operate without them. When week 10 of this series was built on David Maister's book called Managing the Professional Service Firm, and we're deep into the growth phase now. Other weeks we talked about like how to start, how to scale, how to delegate. Now we're here. So a quick recap of week 9 is we talked about managing professionals who are smarter than you, and we identified that talented professionals are motivated by autonomy, by mastery, and by purpose, and not being told exactly what to do. We talked about two types. We say the task doers and the professionals. Task doers are like, go do this, they do it. Professionals are like, I want to know the why behind why I do that particular task. And we cover 3 mistakes that makes professionals stand against you. First is micromanaging. It kills the initiative. Second, undermanaging. It creates confusion. And treating everyone the same doesn't work for anyone. And we broke down what talented people actually need: autonomy over how they work, opportunities for mastery, and understanding the purpose behind their work. We discussed the autonomy accountability balance, clear outcomes with flexible processes, checkpoints instead of check ins, trust then verify. And we gave you ways to motivate without money by challenging work, having growth opportunities, and recognizing the team when they do well, and also giving them autonomy. The exercise was to have a conversation with one high performer about autonomy and give them one area of decision making authority. In this week, we're tackling something that most CPA firm owners are uncomfortable about: client selection and pricing. Because here's the truth: you can't have great systems. You can have great systems, you can have talented people, and you can have efficient processes. But if you're serving the wrong clients at the wrong prices, your firm will never be profitable or even peaceful. So today we're breaking down how to identify which clients are actually profitable and why hourly billing keeps you trapped, and how to say no to clients who don't even fit when you need the revenue. Now, the profitability illusion. Let's start with this question. Do you know which clients are actually profitable? Now, most CPAs think they do. They look at revenue and think, well, this client pays us 50K a year. That's a good client. But often you're looking at the wrong number. Revenue doesn't really tell you profitability, because profitability is revenue minus the cost of serving that particular client. And that cost includes direct labor, the hours your team spends, rework and corrections, the hours spent fixing mistakes, emotional labor, the stress and chaos they create, opportunity cost, the clients you couldn't serve because this client consumed all your capacity. And when you account for all of that, many high revenue clients are actually low profit or even negative profit. You see, revenue is vanity, profit is sanity, and many firms are collecting revenue while losing money. Now, Let me show you what this looks like. The anatomy of a bad client. Not all clients are created equal. Some are more profitable and pleasant. Others are more profitable but painful. Some are profitable and uneasy, and some are unprofitable and painful. And Maister says that you need to identify which is which. And here is his framework. The client type 1, the ideal client. Now, this client pays fair fees. They respect your expertise. They provide information on time, not last minute check-ins or last minute document send-ups. They send the information and give you the time to do your work. They value the relationship and they refer other good clients. These are the clients you want more of. The goal of client selection is not to serve everyone. It's to serve more clients like your best clients. If you can identify what makes your clients ideal, you can replicate them. Second type of client, the profitable but painful client. They pay well, but they demand constant availability, change scope mid-engagement, provide late or disorganized information, create stress for your team, and don't respect your boundaries. And now, here is the key question you have to ask yourself. Is this profit worth the pain? Yeah, is it worth the pain? Is it worth you interrupting me in the middle of the day randomly? I tell you, when you want to contact a firm, reach out to my team. But no, they don't want that. They call you directly because they know that you're going to pick up. And you pick up because they're a client and you don't want to lose them. And you have to ask, is it worth it, them creating this stress for me? Now, I don't know your situation. Only you knows what's best for you. Sometimes it's a yes, sometimes it's a no. But you have to be honest. You have to be truthful to yourself about the trade-off. Because if a client is consuming your team's energy, creating turnover and preventing you from serving better clients, well, the profit might not be worth it. The third type of client is the unprofitable but easy client. These clients now are pleasant. They pay on time, they organize, they're nice, but they're not paying enough for the work that you're doing. Maybe you grandfather them in at old rates and estimated the scope. Then now we have stuff like scope creep, whereby they pay you for one thing and you end up doing some other thing for them. You're doing extra work for free because, the good relationship. I don't know, charge more because I like them and they like me. Now, unprofitable clients are expensive, even when they're easy, because every hour you spend with them is an hour you cannot spend on profitable work, unfortunately. These clients need to be repriced or transitioned, and we're going to talk about how you can do that later on in this video. The fourth type of client is the disaster client. This the hurricane client now. These clients are both unprofitable and painful. They do not pay fair fees or don't pay on time, consume excessive resources, they create chaos, they create stress, and they don't value work. They complain constantly. Disaster clients should be fired. There's no business justification for keeping them. And yet, most CPA firms keep them. Why? Because they are afraid of losing the revenue. But the truth is, losing a disaster client doesn't cost you money. It frees up capacity to serve better clients. And you can ask how? Well, just think about it. For example, if I am making a meal and I don't know how to particularly make this type of cuisine, instead of buying money and wasting resources like gas, water, electricity, and the ingredients to make the meal, I could buy it from a store. Now, learning how to make a meal is different. But if I want to save my time, I would rather go and buy the meal from a store which already knows how to make that meal instead of me trying to make the meal myself. I'm saving my time, I'm saving my resources. At the same time, if I don't want to learn how to make the meal, I could do that in a low pressure environment, but not at that time if I'm in a time crunch. So think of it the same way in terms of like losing a disaster client doesn't cost you money. You actually have more time to serve the client that you actually want, because then now you're focusing on, okay, how do I now serve the clients I have, and how do I then reach out, because then you've cut off this leak. If think of it as a water tank, whereby a bad client is a hole in your tank, and the more that hole is there, the more water leaks. That's excessive use, excessive time, non-stress, chaos. By cutting them off, you're sealing that leak, and hence you're able now to direct things to a more suitable cause for your firm. So how do you calculate true profitability? Most CPA firms don't have this. Like, how do you figure out which client is profitable? And most CPA firms don't have this data. Maybe they track revenue, they track hours, but they don't track profitability by client. And Maister says that this is the most important metric you're not measuring. So here's a quick way on how to calculate it. Step 1. Calculate total revenue per client. This is easy. You already know this number, i.e. the client pays 30K a year. Step 2. Calculate direct labor cost. How many hours did your team spend on this client? Multiply those hours by the fully loaded cost of each person. For example, if your senior accountant spent 50 hours and he charges $75 an hour, that's 3,750. Staff 100, foot hours is 4,000. Partner 10 hours and spent 150. In total, your direct labor cost is 9,250. That step is add rework and exceptions. Did this client require multiple revisions, corrections after filing, extra meetings to clarify scope, extraordinary effort to get information? So estimate the hours spent on exceptions and rework. Examples like 15 hours of rework at $60 an hour blended rate. Now that's close to 900. So your adjusted labor cost is 10,150. Calculate gross profit, revenue minus the direct costs, you get 19,850. Then calculate the margin, which is now a 66% profit margin. Now this client is profitable. But now let's look at a different client. Revenue is 15K a year. Your costs are 10,800. Rework and exceptions 2,100. Your gross profit is 2,100. Margin is 14%. Now, this client is barely profitable before you account for overhead. And if they're also painful to work with, creating stress, costing turnover, consuming partner time, they're costing you money. Big time. So when you measure true profitability, you discover that your assumptions about good clients are often wrong. And why? Now we're going to talk about like why hourly billing keeps you trapped. Okay, so most CPAs I've met also bill by the hour. And this is one of the biggest structural problems in professional firms. And here's why. Hourly billing caps your revenue at your capacity. If you only bill by the hour, your revenue is limited by the hours you have available. I mean, you can only work so many hours. They only do 24 hours in a day. Your team can only work so many hours. So your revenue has a ceiling. Hourly billings turn your firm into a labor factory. You're not selling time. You're selling time, not value. And time is finite. Now, second problem, why hourly billing keeps you trapped, is the better you get at something, the faster you do it. And if you bill by the hour, the faster you do it, the less you earn. You literally get penalized for being good. For example, in the first year, if you prepare a return in 10 hours at $200 dollars an hour, you get paid 2,000. If you've optimized the process in year 5 and now it takes 5 hours, at $200 an hour, you get paid 1,000. So you're twice as efficient and earning half as much. Hourly billing incentivizes inefficiency. It rewards slow work and punishes expertise. Now, the third problem why billing hours may slowly kill your firm is it misaligns incentives. Your clients want the work done quickly and efficiently. Think of going to a restaurant. Will you want the chef to take hours just making your meal? No, you want it in the shortest time possible. I've been in some restaurants whereby I've ordered a meal and 30 minutes in, going to an hour, it's not even ready. And I want to go, but I can't go because I've already made an order. But then that just diminishes the experience of it all, even though the meal is good. I never truly enjoyed because I spent so much time waiting when I had some appointment to catch later on. So you want to build more hours. Those incentives are opposed. When your incentive is to build more hours, your client's interest is to minimize hours. You conflict by design, and this creates distrust. It limits your ability to have value-based conversations because you're thinking in terms of time, they're thinking in terms of the value. Now, let's talk about the value pricing mindset. So if hourly billing is the problem, what is the solution, Asher? So Maister advocates for value pricing called the fixed fee or value-based pricing. And here's how it works. Let's dive in. The first principle: price based on value, not time. Instead of asking, how many hours will this take? Ask, what is this worth to the client? For example, a business owner needs tax planning that could save them $50,000. What's that worth? Maybe 5,000, maybe 10,000. It doesn't matter if it takes you 5 hours or 10 hours. The value to them is the same. If for example you're going to the doctor and you had the flu, and they say, okay, fine, this flu is going to go for 10,000. This flu drug is going to go for 10 grand. You're like, oh, no, I'm not paying that. I'll just wait it out. But now imagine that you had a broken leg. You're going to take it in the blink of an eye because your broken leg is more valuable to you at that time than having a flu. The same is here. When you price based on value, you're compensated for results. Like the broken leg example, you're compensated for making the leg good, not the effort. This aligns incentives. The clients want results, you deliver results, and everyone wins. The second principle is scope clarity is essential. You see, value pricing only works if the scope is crystal clear. You have to define what is included, what is not included, what triggers an additional fee. If the scope is fuzzy, you'll end up doing way more work than you priced for. The clearer the scope, the more confident you can be in fixed pricing. And if the scope changes, then the price changes, and that is non-negotiable. There has to be transparency between you and the client as well. And with transparency, you also bring clarity. So, the third principle is efficiency becomes your profit. When you price based on value, efficiency increases your profit. If you quote 10 grand for a project and you complete it in 20 hours, you're earning 500 an hour. If you optimize it and complete it in 10 hours, you're earning 1,000 an hour. Your revenue stays the same, but your profit increases. Value pricing rewards you for being good. Hourly billing punishes you for it. Now, this is how you escape the time for money trap. So then, let's talk about the hardest part. How to say no to bad clients. Saying no. So most CPA firm owners know that they have bad clients. I mean, you know it already. but you're terrified to let them go. Why? And many think is, if I lose this revenue, how will I be able to pay the bills? And that is valid. But bad clients don't generate revenue. Bad clients consume capacity. And capacity is your most valuable resource. I mean, just think of it. Think of it in a car, whereby you have good fuel and have bad fuel. And you have good and bad fuel and your tank is full. For you to put more good fuel in the car, you have to let go of the bad fuel. But if you don't let go of the bad fuel, the engine won't run well. So, when you're serving bad clients, you don't have capacity for good clients. So saying no to bad clients isn't about losing revenue. It's about freeing capacity to serve better clients, like the engine. By just emptying the bad fuel, you're able to put good fuel. And when you put good fuel in the engine, what happens? Your engine lasts longer. You're able to drive the car smoother. You're able to save on engine replacement costs. And most of all, your mechanic is happy with you. You have a happy mechanic who is just happy because you treated your car well. So here's how you do it. How you free capacity to serve better clients. First, identify the clients who don't fit. Just tell them. Just find it really. Use the profitability analysis we covered earlier. First, identify clients who are low profit or negative profit, high stress or high chaos, misaligned with your services or values. Make a list of them. Decide, will I reprice or will I release? Now, for each client on the list, you have two options. Reprice, whereby here you raise the fees to reflect the true cost of serving them. If they pay the new rate, great, they are now profitable. If they don't, they leave and you're freed up capacity to now get your ideal client. The second option is to release them. Transition them into another firm. Maybe you have a friend, a CPA friend who is just starting up a new firm and they need clients. You could transfer them there to start them as they gain experience or something. Give them a 90-day notice. Help them find someone that is suited to what they are doing. For example, if you say that you want to more specialize in the real estate sector and you have a manufacturing client, it's good, but you're not my daily client. You could then find for them a manufacturing CPA who can help them in that particular expertise. Exit gracefully. Firing a client does not have to be hostile. It's a business decision, not a personal rejection. Step 3. Communicate with clarity and respect. When you raise your rates or exit a relationship, be direct and professional. For example, we've been working together for several years and I'm grateful for that. However, our firm is evolving and we're focusing on clients who need real estate services, your specific needs. Based on your needs, I think you'll be better served by a firm that specializes in manufacturing, their area now. I'm happy to make an introduction and ensure that there's a smooth transition. Simple. They understand, you understand. It's not war. It's just a business decision. You're just aligning incentive. You're helping them as you're helping yourself. So we are adjusting our pricing to reflect the true value of what we provide. Moving forward, our fee for this engagement will be $10,000, $20K, $30K, $50K, $100K. I want to make sure this still makes sense for you. No apologies, no guilt, just clarity. Just clarity. The kindest thing you can do for a misaligned client is to help them find someone who is a better fit for them. Even though the client may be the bad client, the hurricane client they call it. A client who underpays and is painful. It's just a business decision. They may not be bad people, but they may be bad clients. And bad clients are not always bad people, but bad people are definitely bad clients. You could have the most refined CPA who just, everyone has someone for them, right? So, 4, fill the capacity with better clients. The key, say no to bad clients only works if you replace them with good clients. Now, the hurricane clients, that is an exception because that is costing you more than you need. Otherwise, you just lost revenue. So before you exit your clients, ask, do I have a pipeline of better clients? Do I have a way of attracting to attract the ideal clients? Am I marketing to the clients I actually want? If not, then start there. Okay? Client selection is not a one-time event, it's an ongoing discipline. You always pruning bad clients or cultivating new ones. So let's talk about how to define your ideal client. So because if you don't know what you're looking for, you'll take whatever walks through the door. And Maister recommends creating an ideal client profile. Now here is what to include. First, revenue potential. What's the minimum engagement size that makes sense for your firm? If your ideal engagement is 25 grand and above, don't take 5k clients just to fill capacity. They are a distraction, not a foundation. It's like you saying that, you know what, I want to watch a series and I want to watch a Korean drama series. And you end up starting to watch an American movie. Doesn't make sense. It doesn't make sense because then now you're gonna your time is limited. Say that you've given yourself a break time of just a few minutes to watch TV in a day, and now you, instead of watching the series, you're watching the movie, and so which means that the movie is getting into your capacity that you've allocated to watch the TV. So it then now hurts you in the long run because you're like, oh my gosh, this was not what I wanted in the first place. Then if you now leave the movie halfway, you're like, oh my gosh, I want to finish it, but I'll have to do this. Avoid it. Second criteria is service alignment. Does this client need the services you're best at? If you specialize in construction accounting and then healthcare, I mean, even though they're good, they're paying on time, it's not good. I mean, just you could transfer them out because specialization attracts better clients and commands higher fees. Generalists compete on price and specialists compete on expertise. So if you're in construction and then healthcare, even though they're good, they are amazing clients, you have an amazing relationship, it's not a fit for your company, for your type of business model. Because as I said, generalists compete on price, specialists compete on expertise. The third criteria is value alignment. Do they respect deadlines? Do they provide organized information and value your expertise? Or do they treat you just like a commodity? The clients who respect you are the clients who you should serve. The ones who don't will never be satisfied no matter how much you do. And always trying to please someone will lead to extreme burnout, not only for you but the people working at your firm, because you're trying to meet this goal that can never be met. The fourth criteria is growth potential. So is this a one-time project or is there potential for ongoing work? Ideal clients have multiple needs over time. They become relationships, not just money. The money translates to just more than just numbers on the page. They actually mean something that they yeah. Anyway, they become relationships, not transactions. The fifth is the referral potential. Do they know people like them? Great clients refer great clients. Bad clients refer bad clients. Your client base compounds. So choose the initial clients carefully because they determine who comes next. Basically, the quote, You are the sum of 5 people you hang around with. If you're around 5 rich men all the time, my friend, don't look for the 6th, because you are the one. So how to start this week then? Here's how to start improving the client base this week. First, analyze your top 10 clients by revenue. List your top 10 clients by revenue. For each one, calculate total hours spent, direct labor cost, and profit margin. Identify the ones which are actually profitable. You might be surprised. Second, identify your bottom 5 clients by profitability. Who are the clients consuming the most resources for the least return? Write them down. These are candidates for repricing or releasing. Action 3. Create your ideal client profile. Write down the characteristics of your best client. What makes them great to work with? Use that as your new filter for new clients. If you don't define what you want, you'll get what's available, not what's ideal. For example, for my company, my ideal client is first, your CPA or managing partner in a firm. 2, you're running from 5 million from 1 million to 5 million in revenue. 3, you have from 10 to 25 employees. 4, you're in your growth phase, so it's solo, small, growth, mid-tier, then large farm. So you're in your growth phase. 5, you're currently experiencing operational issues whereby you're trying to track processes, things are getting lost in the you feel that if you get on more clients, you can't handle more clients. So you reject clients because you haven't fixed your current capacity, because you're having operational bottlenecks. And a lot of things in your farm revolve around you being there. You cannot step away from your farm for a moment, because then you're going to have like calls, things will not go, things won't go. 6th is also quality. You have to ensure quality all the time, in terms of the quality in your farm is dependent on the person who is doing the work. It's not standardized. So I help with that. Our company helps with that. And that's some part of our ideal client profile. 4, reprice one client. Pick one client who is underpriced. Schedule a conversation with them. Then raise your fees to reflect the true value and cost. If they say yes, great, you have improved profitability. If they say no, you've freed capacity. Either way, you win. 6 is practice saying no. The next time a prospect comes who doesn't fit your ideal client profile, say no, politely, professionally. Thank you for thinking of us. I mean, based on what you've described, I think you'd be better served by X type of firm. I'm happy to make a referral. This feels so scary at first. Every no to a bad client, though, creates a space for yes to a good client. Now, the mindset shift here is most CPA owners are afraid to let go of clients, even bad ones, because revenue feels like safety. But Maister says that it's an illusion, because bad clients don't create safety, they create fragility. They consume your capacity, stress your team, and prevent you from serving better clients. Real safety, my friend, real safety comes from serving the right clients at the right prices. It comes from having a firm that is profitable, not just busy. And it comes from having the courage to say no. The firms that thrive are not the ones that serve everyone. They are the ones that serve the right people exceptionally well. And you can't be exceptional if you're exhausted, always tired, in a flight of flights. You're always just weighed down by bad clients. So choose who you serve and design your pricing to reflect the value that you create, Right, so let's summarize what we covered today. We can pricing, profitability, and say no to bad clients. We're talking about the profitability illusion. Revenue doesn't tell you profitability. Many high revenue clients are low profit or negative profit when you account for true costs. The 4 client types: ideal client, profitable and pleasant. Some of those: profitable but painful, high revenue, high stress, ability trade-off. Unprofitable but easy, pleasant but underpriced. Here, you reprice or release them. And disaster clients, unprofitable and painful. Here, this one you have to fire them really quickly. So, how to calculate true profitability? Revenue minus directly labor cost minus rework and exceptions equals gross profit. Measure profit margin by clients who measure the profit margin by client to see who is actually profitable. Like, just take each client and work each client. When you see your margin for each client and see who is the most profitable client. We also talked about why hourly billing keeps you trapped. It's because first, caps your revenue at capacity, punishes efficiency. If you get faster, the more faster you get, the more lower price that you have. For example, if I did stuff in 10 hours, now I'm faster now. If I do it in 2 hours, 5 hours, right? And I still price for the same thing, then my money goes down because I'm doing my things faster. So it punishes efficiency and misaligns incentives with clients. The clients want things faster, and because you want to, get paid more, you take your time. So, conflict of interest. Value pricing mindset. Buys price based on value, not time. What is it valuable to the client? I gave the example of a client having a tax return. Whether it take 10 hours or 1 hour, the client still values it at 50k. If that's a 50k issue, they value it at that much. It's like going to the hospital and you have a broken leg, something, right? And you go see the doctor. Now, if they quote you 10 grand for fixing up of your leg, whether it's today or whether it's tomorrow, the value is still the same. And you'll actually prefer them to do it faster than just taking more than 1 day. So, price based on value you're giving to the client, not the time you're taking to complete the work. Second, scope clarity is essential. Know what you're working on. Because if not, then it's going to start creeping into things that you're not paying for, and you end up overworking yourself and underpaying yourself. Efficiency, the more efficiency becomes your profit. Because basically, if I can complete things, if I have this value-based pricing and I complete things on time, faster, then I get more money even though I'm pricing the same. For example, if I'm pricing something for 10 hours and I get 10,000, and if I'm able to put it down, I put it 5 hours and I'm getting that same 10,000. After some extra 5 hours to do other more types of work, yet I'm still getting the same amount of profit rather. So that's good. And how to say no to bad clients? Identify clients who don't fit. Decide, will I reprice this client or will I release this client? So once you have decided that, communicate with clarity and respect. Also, fill capacity with better clients. It's better you say no and you find ways to attract clients than saying yes, and when good clients come, you can't get them on because you have your capacity filled with clients who might not be your ideal type of client. So the ideal client profile: define clients by revenue potential, service alignment, value alignment, growth potential, and referral potential. So how to start this week? Analyze your top 10 clients by revenue for true profitability. Identify your bottom 5 clients by profitability. Create your ideal client profile. Reprice one underpriced client. Practice saying no to prospects who don't fit. And the mindset shift here is bad clients don't create safety, they create fragility. Real safety comes from serving the right clients at the right prices. Firms that serve Firms that thrive serve the right people exceptionally well. Not everyone. Okay? The firms that thrive serve the right people exceptionally well. They don't serve everyone. So this Thursday we're talking about something that makes most technical experts uncomfortable. Leadership in a CPA firm, even if you hate managing people. Because the truth is, most CPA firm owners became CPAs because they're good with numbers. Maybe particularly not people. And they don't want to be managers. They don't want to deal with drama. They don't want to motivate or inspire. They just want to do good work. But might they say that leadership is not optional if you want to scale. So next week rather, we're breaking down why leadership is behavior, not personality. The difference between managing and leading, how introverts and technical people can lead effectively, the 3 leadership behaviors that actually matter. This is going to reframe what leadership means in a professional firm. So, the exercise for this week is run the profitability analysis on your top 10 clients by revenue. Calculate their true profit margins, then identify which clients are actually driving profitability and which ones are consuming resources. Make decisions based on data, not assumptions. And that's it. So, thanks for watching. Now, go analyze your clients. Wow.